The Hedgeless Horseman here. It's December the 29th, 2022. This will just be a short video, or hopefully a short video, about my overall theme, why I think commodities is the place to be and has been for quite some time, and I think it will be for many years still yet to come. I mean, at the end of the day, I mean, we could invest in obviously anything. I mean, regular stocks, Tesla, Amazon, Apple, uh, small tech stocks, whatever. And what I think it makes total sense right now is simply to be in the thing with the best risk reward, as always. And I can't really come up with better risk reward than commodities overall. Not that every commodity will do very well. For example, I don't expect commodities to have some kind, the type of returns that the shit coins in crypto had, and even Bitcoin, etc. But I think there's the underlying theme here is that there is a giant supply issue, and we can see that and I've shown these before. It was like 5-year LME zinc warehouse stock level at 5-year lows. Here we have nickel barely off 5-year lows. Here we have copper inventories at pretty much 5-year lows, and here we have lead, which is been pretty much making new 5-year lows. Obviously, that isn't a sign that these metals are plentiful. No, it's obviously the opposite. And why is that? I mean, thanks to ESG and nobody being able to open a mine anywhere pretty much. And we've seen Crescat has done a good job at highlighting the reduction in capex, etc., and exploration expenditure, yada yada yada. So that's like the main thing, and obviously that's a great thing to have if you're a bull, obviously. Supply issue. There's just not that much supply. So, I mean, given the state of the world economy and the geopolitics, etc., there's a bunch of stuff going on at the same time. What we do know is that nobody can put up a big mine just like that. I mean, typically it takes years, if ever, you're even allowed to put up a big mine. And then we have, the problem with in Europe, especially electricity costs, etc. You see, plants, etc. shut down. I mean, you're not gonna run an unprofitable mine forever because you'll go bankrupt. And we've seen the labor shortages and cost inflation in Australia, for example. There's a bunch of mines in, I think, especially Western Australia, that were put on care and maintenance because the labor situation was just unsustainable. Labor costs probably up, 40% or something in just the last 1-2 years. That also brings supply offline, obviously, if you close down mines. And we've seen a bunch of juniors, especially in the gold and silver space. Almost none of the juniors that tried to go into production over the last 12 to 24 months were able to. That means there's no new supply coming there. Pretty much everyone went either bankrupt or at least they had to shut down the mine. That's not helping with the supply issue, obviously. So there's like an interesting cocktail where we have inflation in costs and regions, etc. And that's also thanks to geopolitics, etc. But also thanks to supply issue. That is like going full circle, I was gonna say, because I mean copper is not too low. I mean it's close to the highs since 2006. Zinc is level here that's only been higher here and back here, so that's relatively high. And you have lead, which is also around over the mean level at least since 2012. So the commodities themselves, which obviously go into everything you need to build when you build a mine, all the, let's say, materials, etc. And obviously one of the biggest things have been the high oil prices, but that's coming off now at least, and that is a major factor of operating costs for mines. But it was recently, kind of just a few months ago, it was up here. Now it's going back, but still you can see, I mean, it's not too low at least, and it has been ramping quite a bit, I mean, over the last 6 months. And this obviously killed the economy back in 2008, and then we had a big crash. And that's again kind of typical, and you can see that in copper the same ramped until it crushed the economy. Same with zinc, pretty much up all the way up here. We're not even back to those levels, haven't even really gotten too close to those levels, and then the economy tanked. So it kind of kills the economy and obviously reduces demand, so base metals especially get crushed. But that's what I think is interesting. We know the debt levels around the world. We know that there's people expect recession in 2023, so we know there's going to be a reaction to the recession. I mean, what happened after every crash? Well, zinc didn't do, I guess, too much, but still, that's like from what is that, 4.7? I mean, that's up 100% in not too long of a time. Copper obviously made a bottom, then super ramped. Lead, okay, this one doesn't go back to that, but it from the major bear bottom in metals went up, almost 100%, and that's a boring thing like lead. But the main point is that, I mean, there's a shortage of supplies, and I don't think the economy is doing that good. So despite the global economy softening, China having been in a lockdown for I don't know how long, you still have very, very, very depressed inventory levels. So the question is, I mean, from a game theory perspective, what if we don't go into a severe global recession? How is the supply issue going to get fixed? It's not going to get fixed anytime soon, and then these levels might, I mean, force higher prices, let's just put it like that. And if we do go into a global recession, base metals might tank, etc. I know if you've been listening to Felix Zulauf, he believes there's, base metals might get soft, or might be soft towards or until, at least until first half of 2023 or something. Then they expect some response from central banks and governments, etc. We know there's, I think in the US there's like a big infrastructure bill, for example, and obviously China opening up now, yada yada yada. So I mean, that's not too long from here. So even if we go into a global recession, it might crush base metals for some time. But as always, people are going to respond to that. The ones who want to be elected are going to respond to that. They're going to respond to everybody's pain. So we might see even more spending and inflationary stuff like the COVID, what's it called? When they basically helicopter money in the US during COVID, and then we had recently the highest inflation like 40 years or something. So I mean, there's consequences to that obviously, and then gold and silver did pretty well, especially gold, and oil did well. I mean, what's this? Lead has done well, zinc did well, yada yada. So from a timing perspective, I don't care too much about that, because as I see it, we can't pretty much lose, especially if we're somewhat diversified, because if if the global economy does okay, we have a big supply issue. If it tanks first, there's going to be a response with a big supply issue. And, you know, we might have Felix Sulaf expects a base metal rally next year, so there will be like a final pop, let's say. And then he believes that gold will pretty much do well throughout this entire, the later stages of, or for the rest of the decade, pretty much. Because everything is going to, highlight the debt bubble, the monetary mess we're in, that it seems, gold is already kind of front running. So again, as I see it, you can't really lose with commodities because simply because of the supply issue and the monetary mess and debt levels we're at. And I think they might, take turns in leading. We might have, some relief rally in base metals now and then with a relief rally in the stock market or whatever. But I mean, at the end of the day, how this is going to go down is probably like it has gone down every other time reserve currency fails, etc. I mean, gold and silver are going to be the kings. They're going to be, the things left standing when fiat burns down. But still, again, there's a shortage in almost every metal by the looks of it. And this is during a time where the global economy is not that strong. So I can see, my portfolio taking turns of, battery metals, green metals, etc., doing quite well, and then maybe gold and silver does poorly a bit, and then focus again turns to the imbalances of the global monetary system and debt levels, and then gold and silver does well, etc., etc. So if I had to pick some metal for the next 5 years, I would probably pick gold. But in the meantime, I think all could do pretty well. And then, when you think about stuff like AI and, automation, if that's even how you say it. I saw a clip on Twitter recently, the first, I think, fully automated McDonald's or something. I mean, there's a bunch of jobs that can be automated and increasingly will be. And then you have AI, etc. But the thing is that, yes, okay, if you had a very low skilled, if you were very low skilled labor, you might get replaced by, let's say, a robot, or AI might make your job position redundant or whatever. But still, AI can't print commodities. I mean, that's like the lowest common denominator. Again, if I even say that correct, I'm not sure. Are the commodities. So I mean, how are you? I mean, even the robots are gonna get built by something. They require metals, copper, wiring, steel, aluminum, silver, gold, etc. in the circuits, and tin for the chips, etc. So as I see it, it's like, even if we're, as always, going into a more technologically advanced future, I don't see anything that has a better risk reward than commodities. Imagine you owned all the copper mines. Even if we go in a world where it's like everything is automated, there's AI and robots, yada yada yada. Obviously, that would require a lot of copper, for example, and again a lot of steel, etc. So I really like the idea that commodities are the foundation for everything, basically. I don't care how a car is made, a car will still need all the metals, regardless if it's 100 people building a car or if it's 10 robots building a car. A car still requires, rubber wiring, especially, I mean, copper, especially for the green cars, the electric vehicles. And we know that, for example, Canada recently put something, legislation or something that by 2025 or 2026, every fifth car or so, one of every fifth car has to be an electric vehicle. So that kind of is forcing demand. I mean, it's basically legislating demand for green metals. Okay, it's only Canada, it's not the largest country in the world, etc. But we still see the kind of the same stuff all over the place. So I mean, you have a supply issue that's been chronic for quite some time and still is. I mean, there's problem with South America now. We've seen some headlines from, I don't know if it's Chile or Peru or whatever. It's not making it easier, and we know the green movement. I mean, they hate mines, but the same ones that won't allow mines to go up, thus cementing the supply issue. They're also making laws, etc., that is going to force demand for those metals to go higher, unless something changes, obviously. But it's like a perfect storm, I would say, for especially, let's say, battery tech metals. It's like, okay, you can't build any mines really, or not up until now at least, but they are right now. For example, in the West, they're talking about critical minerals, actually giving grants to nickel mines, and there's a bunch of other mines that might get grants as well. So that's going to alleviate the supply picture in the West. But at the same time, you have that, the reason for this is because they are putting down the demand for such minerals and metals in written laws, that you must build more electric cars, etc. You must have this and that, and you're gonna have more solar, and you're gonna have more wind or whatever. So I mean, I think it's basically a perfect storm. And well, obviously, almost nobody. I mean, the public has no idea. They don't care about mines. They don't know where the metals come from. They don't know what's going into their iPhones. And then you have geopolitical tensions. It's like, okay, obviously China has been buying up commodities and building infrastructure, yada yada, all over the world. I mean, they're still buying gold mines for their, I guess, state-owned gold miners, or semi-state-owned, I guess. So you have this kind of geopolitical scramble to secure your own metals, as inventory of metals are going down, and you're still not really allowed in many places to build mines. And even if you are allowed to build mines, there's a lack of capex, there's a lack of financing. Obviously, that's why even the US Defense Department is gonna be forking up cash to help out miners bring mines into production. So again, it's like, I would say this is a perfect storm for commodities going into the future. And not every commodity will do as well as the other, obviously. And I think they will, kind of take turns leading. But at the end of the day, it's like, these are my overall macro themes, let's say. I don't know what technology will rule in the future. I don't know what AI will do. I don't know what automation will do. I just know that whatever we do, whoever produces whatever gets produced, it's going to require commodities. And AI can't, maybe it could solve like a material problem, that it, substitution or whatever, but that also takes time, and you have to refit plants and yada yada. I mean, there's talk of regular sodium replacing lithium, in the future. That might happen, who knows. So there's always going to be some kind of pressure on that department, substitution. But I mean, some of these metals are kind of, unique. I mean, silver is, I think, the best conductor of electricity. And silver isn't really expensive. It comes out as a byproduct in many, copper, zinc, and lead mines anyway. And then you obviously have that kicker if we go into a monetary crisis, or it really, I mean, we're already in a monetary crisis, but if people actually care about it, the average, the median voter or marginal investor, they're probably going to buy some silver simply because it's cheaper than gold, and you're going to have a demand push from that front as well. But at the end of the day, I don't see, again, from a risk reward, and it's like playing out different scenarios. You have the pros and cons, you have the SWOT analysis or whatever you want to call it. I simply don't see anything better than commodities. And we kind of know how it will probably end. That's going to be with some kind of big revaluation in gold, because this, at some point the system can't take it anymore, and we go into, we already have big inflation, and even if rates are this low, for example, and people, well, let's say the system pretends like it's transitory or whatever, that doesn't change the fact that, okay, if you have a savings rate of like 1%, you have a increase in salaries of like 3-4%. Let's say inflation keeps up at 6% or something on average over the next 5-10 years. Sure, you can have low rates and you can pretend that savings rates shouldn't cover inflation. That doesn't change the fact that everybody, the median worker or the median household will just get poorer and poorer and poorer, because their purchasing power is going down, because their salary increase and or savings rate doesn't cover inflation. So that's going to force a response from the powers that be. I like the saying, you can ignore reality, but you can't ignore the effects of ignoring reality. So I don't know how long this charade will last. Until we have some kind of reset. And it doesn't really matter that much, I think. It's I think, like Rick Rule says, it's better to have a case that is where it is a matter of when, not if. And again, in the meantime, we're gonna have a lot of volatility, up and down. It's like now people are calling a top in silver or gold, paper, silver, gold, and it's like scaring everybody, and everybody gets affected by it, because again, what we fear the most is that what we own today will go down tomorrow. It's just human nature. I get affected by the same thing. If I read a tweet that's like, yeah, silver, gold is gonna go down, and it's in an alarmist way, then you get alarmed. While at the same time, when I take a step back, it's like, I've never tried to time the paper, gold, and silver price. First of all, because it's pretty much impossible. 2, because I'm a value investor and I'm into mining companies. 3, because mining companies don't necessarily follow gold and silver, paper, gold, and silver too much. And we have no idea when something might, let's say, break for real or whatever. And, 4th or 5th, if you buy something that you think will go up a lot in value over the next 1 to 2 years, that's going to take care of a decreasing metals price anyway. Sure, you'll have big swings. We see even in the best units, they have big swings. But if you just take advantage of that volatility, let's say they become way too undervalued, that's opportunity, even though, in the recent past, it's pain, because paper prices are going down, so you're losing on paper, but that also opens up a brighter future, obviously. So you use that volatility anyway, and if a case is intact, and if a case, the base case you have is this company is going to go up 200% in value over the next 2 years, and it's already undervalued, let's say, who cares if silver goes down 5-10%? If it does, and this intact case goes down 20-30%, it went from a really good buying opportunity on a 2-year basis to a great buying opportunity on a 2-year basis. So it's both a blessing and a curse, obviously, when prices go down, depending on how you look at it. But we know how most people are, and I'm gonna talk more about that in another video. People buy the things that are going up and sell when it's going down. The more that it has gone down, the more they want to sell. The more it's been going up, the more they want to buy, and that's why you get decimated over the long term. Whereas, I mean, in reality, obviously, if you had a fat position here in gold, that would have done wonders. And you could even have, afford a dip like this here from here, if you bought here. I mean, just buying cheap is like universally good, has been for forever, basically. But that's not how people operate. That's why it's so hard. But again, just to sum up, I guess, this perhaps chaotic rant, I don't really care what happens in the short term. It's like I've said before, beating the market short term is almost impossible. Well, it's extremely difficult, at least. I don't even play that game. I don't think there's much of an edge there. I have no idea where gold and silver is going to go today. I have no idea where copper or any other metal is going to go today or tomorrow or next week or whatever. I'm into buying cheap companies in favorable, let's say, macro trends with a bunch of tailwinds. And the biggest tailwind we have in almost every commodity right now is that there's been a supply issue for quite some time, and every mine today is going to be depleted one day. Every passing day that the miners pull up the metals, etc., that means less supply in the future, and the juniors are going to have to be the future supply, and they happen to be dirt cheap in a lot of instances. So I don't know exactly what junior is going to do well. I don't know exactly what metal is going to do very well over the next 5-10 years, but I would say the risks are to the upside in almost every metal until something changes. Maybe we go back, 50 years ago you could go from discovery to production in just a few years. Nowadays it's, again, I think the average time to put up a mine, a large mine from discovery is like, 10-15 years or something. So even if you have a problem now, how are you going to fix that if you can't put up a mine, any material mines in the next 10 years? The supply issue is here right now. It's not here if we don't put up many more mines, there's going to be even worse, in the future, if this green trend continues and we don't have a total collapse in our global economies. And if that happens, obviously your gold and silver, especially your physical gold and silver, will be priceless. So, physical is the that is the base. That is really my hedge against my mining portfolio. Physical gold and silver. Because everything else you take on risk. Risk of default, risk of depletion, risk of whatever, management team, risk of running out of money. A gold coin has all the sunk costs embedded already. And it's like, in an inflationary period, why do you like sunk costs? Because future costs are going up, or costs that might be taken now are higher than it was a year ago. So let's say, oil and whatever goes to the moon. It costs $2,000 to buy a gold coin, and you can, let's say $2,500 to produce a gold coin, and you can buy it now at $1,800. That's already been recovered from the ground and smelted and obviously minted. So that's, sunk cost right now. I really like that, and that's also a reason why I don't think too highly of early stage exploration companies right now, because even if you have some 5 million market cap company, and there's exceptions, etc., but there's still, mines or developers or advanced juniors that might have a market cap of, I don't know, 50, 60 to 100 million with multiple million ounces of gold. So if you have a 5 million early stage explorer, even if it's just trading for 1/20th of what a 4 million ounce 100 market cap advanced junior is trading at, okay, first of all, they have to be lucky enough to have a system that could deliver 4 million ounces. Then it's going to require years and tens of millions just to prove that up. So even at surface, it looks, hey, why should I pay 100 million for this advanced junior when I can buy this one for 5 million? And we know they can go up a lot, the nano caps, etc., simply due to sentiment. And that's fair enough. I mean, I don't mind that too much, because this market is, if it's anything, especially the junior mining sector, if it's anything, it's irrational. But still, it's like, okay, I'd rather buy something cheap that has already happened and I take no risk than buy something that looks very cheap. But there you have all the exploration risk left, and they have to dilute and finance many times over many years to even reach the stage. So if a 5 million market cap early stage pre-discovery play were to redo all the steps it took to become what the 100 million market cap company is right now, it's actually expensive. Because if you count for all the dilution, if you count for all the time and drilling, permits, etc., you're taking a lot more risk, obviously, because it's not guaranteed that they will even be able to, because of permits, etc., to prove it up. There's no guarantee that they will even prove it up. And if all that goes through, they still have to raise a lot of money. And it will take X amount of years. So the risk reward in the more advanced, the more banked future supply in a time of supply issues, I think it's like no-brainer cheap. And obviously, again, if nothing gets fixed, nothing big gets fixed in the mining space, we're gonna have tailwinds for years to come. Because, politicians, etc., they're very slow to wake up. And even if they woke up now to, we need a bunch of more nickel mines or whatever. It's like, yeah, that's not gonna happen in a hurry. There's in nickel, there's 2 feasibility stage juniors right now. And yes, there's some large undeveloped nickel mines around. Maybe they will be in production in 5 years. Who knows? But from here to 5 years, that's a whole 5 years. So they're not gonna bring on a supply anytime soon. And then you have the Indonesian supply of nickel, but who knows? Maybe that will stay in China. Maybe we'll go into an even more balkanized world, where critical metals they stay where they are, kinda. So I think that's also one thing to keep in mind. Again, the geopolitics, and at the same time, it's like, hey, I'm kind of warm to Africa because they don't have the same ESG focus. It's much easier to build mines in many parts of Africa than it is in the West. And if that's if it's a pure trading sardine, one would probably want it to be in the Western world, where it's years away from having to become developed, let's say, because people pay a premium in projects in Canada or whatever. I hope some of it made sense, but I guess, again, to just wrap up, I can't see anything other than commodities that is a no-brainer. The overall market still isn't really cheap. Miners and juniors are already really cheap right now, and given the supply issue that you can't print these metals, I think we're going to have tailwinds for quite some time. And again, even if we go into a global recession, let's say battery metals and base metals take a hit, there's going to come some kind of response. And if it doesn't, or if it fails or whatever, we're going into a pretty chaotic world, and in that case, gold and silver will shine. And if we do not go into a recession, or we go into a short recession and the powers that be respond to it by printing and, printing out more infrastructure bills and throwing trillions of dollars or whatever, I think base metals and EV metals will do very well, and gold and silver should do okay. So it's like, as I see it, if you have some kind of diversification across commodities overall, you're pretty much set up already. In that case, you're kind of agnostic how the path forward is. And of course, I mean, most people want total perfection. That's why they never want to have a drawdown. They only want to be a part of this move, and then they're out, and then they want to be part of next move, that their portfolio never has a severe correction. And they also, again, want to be in the perfect commodity all the time. It's like, I don't care, the market averages 8 to 9% per year. Now you have a bunch of miners that are like undervalued by at least 50% easily, and you have favorable tailwinds. So in my book, it's like, hey, if EV metals, battery metals, and base metals do well, many of these juniors could pull 500% over the next 3 years. Okay. If they don't do well, because base metals don't do well, or green battery tech metals don't do well, gold and silver is probably going to shine. So those juniors might pull 500% over the next 3 years. And when you average that out, I think at the end of the day, it's going to be a portfolio that has averaged more than 8 to 9% over the next 3 years, regardless of how the economy looks. It's just going to be a difference in what actually performs well. I'm not after perfection. I'm after a good risk reward and buying cheap. And like, why I pounded the table, for gold and silver miners going down here. Why? Because they were so cheap. They were already pricing in maybe a gold price of here when it was up here. And then all of a sudden, it turned around and some went up like 100, 200% from the bottom. Some are not even up that much. Some are even making, around 52-week lows, etc. But it's all about risk reward. Why on earth would you not buy something that's dirt cheap here that's already pricing in this? Why? Because you fear it might go down more. You focus more on the next 20% down than the possibility of 100% up. When things go down, people focus on risk instead of how much they're gonna make. When things go up, they focus on how much they're gonna make, not how much they, it should go down. That's just how it is. So I mean, one big thing I think is that like we have to rid ourselves of our need for perfection. If you just hodl cheap stuff, quality stuff, with good management, time is your friend, especially when we have supply issues like we have now. And if you're a bit diversified, etc., yeah, I think it's gonna do. You're gonna do very well, even though for some reason everybody's out there chasing 10 baggers. And I've shown, it's like if you are only into stocks that you think will have on average a double within 2 years, that's 42% per year. That's exceptionally good returns. And yes, we read stories about this and that guy made 50 million on options, or 20,000% on Dogecoin sold the top, etc. I mean, those are incredibly rare stories. If you just take the, I don't know, rational sound route of like value investing, sure, you might not have 10,000% in the next year or two, but in time that's going to add up. Even with 20% compounding per year, it's going to become a lot of money. Yeah, maybe this was a bit of a chaotic rant, but again, the point simply was that I don't know any asset class that has such good fundamentals overall, regardless of how the future actually is. I mean, what's going to happen then commodities, mainly simply thanks to the supply issue, because regardless of what you're going to make in the future, commodities are needed. And if it all goes to shit, gold and silver will probably save your entire portfolio. If it doesn't go to shit, I think gold and silver will do pretty much okay, especially if you buy cheap, if you own cheap companies. And your, let's say, copper, tin, nickel stuff will do very well, because the world is going to need a lot of copper, tin, and nickel if the economy grows. So I just don't see how that's why I'm not really worried about it, because okay, let's say we have a market crash, everything goes down, but then I just ask myself, yeah, but what comes next? We know that everybody is going to be screaming in pain, and the politicians are going to be forced to do something. It's like, they talked about the Fed put. Anytime the market went down like 5-10%, someone was out there talking up the market. Sure, you can do that and don't put up any more mines, but it's getting kind of critical in a lot of stuff. So you can talk up the market, lower rates, pull forward demand, but that's not going to fix the supply issue. It's going to worsen the supply issue. And I don't see this going away anytime soon. So that's, I guess, what I mean. It's like you can ignore reality, but you can't ignore the effects of ignoring reality. That's why you had oil go to whatever it went, because nobody wants to invest in oil. And that's why we're having an electricity crunch right now, or sky-high prices in Europe, for example, because everybody ignored reality. That we didn't have the infrastructure, and nobody's drilling for new wells, etc. So as soon as reality hits, I mean, a lot of things can change. And again, if you keep pulling demand forward and not putting up new mines, this is just going to get worse, and prices are going to be forced to go up. And if you do end up fixing it, which I don't see how you can right now, then we can talk about it, but that's like probably many years or decades away from getting solved, especially if we're going to have this EV revolution, which requires, I don't know, like 60 new nickel mines by 2030, and 300% more lithium or whatever. I just don't see how they make ends meet. I don't see how they put this together. Lowest common denominator are the commodities, because they are the foundation of all economic activity. Thanks for listening. Consider me biased if I talked about any particular company. I don't think I did, but yeah, these are just my thoughts. But I'm very comfortable being in commodities, extremely so. And as always, the hedge to any company we own, all risk assets, and miners are risk assets, that's the physical gold and silver. And all the sunk costs are already taken care of if you have it in your possession, obviously. So it doesn't matter if inflation keeps going higher. It's going to cost even more to produce 1 ounce of gold or silver, and if you've already bought that, it doesn't affect you. It just makes it more expensive for the guy that's going to be buying in the future. Thanks for listening. Bye.